Hi, I'm Keith McCullough. Welcome back to Tweet Keith, which is effectively where you tweet me your questions, and we try to find the top 3 questions that are relevant to today's market day. So let's just get into it. The first question is from Mark Gendron, and Red Gendron, by the way, just left Yale, a fantastic hockey coach. He's now coaching the Maine team. Look at Mark. I don't think you're related to Red, but you said good morning, so that's how you got onto this. Good morning, Keith. You still think the Fed won't taper and markets are going to be bought? Yes, I actually do think that. I think next week the Fed will not taper, and in fact, I think that's why the dollar is most likely to go down on that, and things that are related to the Fed not tapering, in other words, the easy money trade, which would include bonds going up, gold going up, equities going up, basically everything goes up in the face of a no taper because, again, everybody's a winner in that environment, and no, despite the data or in spite of the data, of course, the Fed should have tapered 3 months ago. I don't think that the Fed's going to taper. So that's the first question. The second question is from UPEH Financial. Is there a case to be made for short U.S. bonds and long gold? Now, this is a bit of a Jedi mind trick question. It's a very good question because these two things typically don't happen at the same time. In fact, they haven't happened all year long at the same time. So in other words, when rates are going up, gold goes down. So there really isn't a case in our model for that. Again, the antichrist of gold is rising interest rates based on some kind of an expectation of growth accelerating. Now, we don't think that those two things obviously can happen at the same time. In other words, gold can't go up in the face of rising bond yields. So from here, what's interesting in the gold market to us is that U.S. economic growth can slow from like 3.6%. So it's kind of been this year where a lot of people weren't bullish on growth, and that's why growth really worked. So gold went down, interest rates went up, and growth stocks went up. But we think here growth in the U.S. is actually starting to slow. So in the face of that, interest rates would fall, and you could start buying gold. But again, you want to be really time and price sensitive on that. Third question, and this is from USA Air Force vet, I think. What good is the Fed releasing old minutes and giving guidance when every one of these Fed governors shoots his mouth off with conflicting views? Now, again, this is right on the money. Now, if you go back, and not to make people really think about this, but if you go back to when the Founding Fathers created this country, do you think that they really had this in mind? Like some dude named Bullard saying this, and this Fed regional guy saying that, and them getting paid $25,000 to get paid at a lunch to whisper this and that? I mean, the whole thing obviously is absurd. The absurdity of it all is obviously born out of a bubble. And there's a bubble. A lot of people like to talk about bubbles. We've been talking about bubbles for a long time because, of course, the Fed itself has created bubbles. So they created the gold bubble, the foreign currency bubble, there's an MLP bubble, there was a bond bubble, there's a stock market bubble that's obviously developing. So there's bubbles everywhere. But the most obvious bubble, and this is really embedded in your question, it's in central planning. I mean, what kind of a joke is this that these people get all this airtime, all these TV channels love to do this, and again, it's because that's all that they have. They have nothing left. So they have to have access to government bureaucrats, to your point, that aren't even close to on the same team on this stuff. So again, with that happy thought, I guess we can go into the weekend and enjoy it. Thanks for your questions. I'm Keith McCullough. @Keith McCullough is obviously my Twitter handle. If you have any more questions about this stuff, please tweet me.